Are you afraid of running out of money when you retire? Today, we're going to talk about things you can put in place in your estate planning to prevent you from running out of money when you retire. I'm Roy Thomas from Sutton Group Professional Realty and Halifax Senior Living. I help seniors who are looking to downsize their house and right-size their life. Sitting here today with Fred Perry from Hub Financial. Fred's going to talk to us a little bit about things that people can invest in when you're doing your estate planning to make sure that you don't run out of money. So Fred, I'm going to turn it over to you, but to start with, perhaps you just tell us a little bit about yourself and what you do for a living, and then we'll jump into the topic.
Roy, it's always a pleasure coming back every time and having this great discussion with you on various topics.
Thanks, Fred.
And my name is Fred Perry. I have over 50 years in the financial service business. And basically what I do is I work with seniors in the areas of investments.
Okay, so a lot of times, as you know, a lot of times I'm helping seniors downsize. They've sold their house and they're looking to use that money as part of their retirement investment. You know, now that they've got the house sold, it's liquid, they're going to need to put that money in different types of investments to give them income to support them for the rest of their life. So if you were sitting down with, say, a senior, maybe they've sold their house, maybe they haven't, but they're looking to do some estate planning, what sort of steps would you go through with that senior to put a plan in place so that they don't run out of money?
Well, one of the key factors I want people to understand is that every situation is different. There are a lot of variables out there when you're talking about investing. You know, are you looking for tax breaks? Okay. Are you looking to grow your wealth at a fast rate? Are you looking to be conservative? As long as I get a little bit, I'm happy.
Okay.
So that's the area, but it's a very complex issue when we're talking about this because everybody's situation is different when it comes to investment.
Obviously, everyone has different levels of risk tolerance.
That's correct.
So if you're sitting down with somebody and you want to try and find a plan that's going to make sense for them, that they're comfortable with, how do you deal with their risk tolerance?
Well, one of the things that we have is what we call an investment profile. The investment profile is designed to ask pertinent questions about their risk factor to find out, are they a conservative investor? Are they a balanced investor? Are they a mid-range to high? And are they a risk taker?
Okay.
And what that investment profile will tell us, it will tell us that where their risk tolerance stands.
Okay. So then you would use that level of risk tolerance for that particular individual you're meeting with to design the program that you would recommend that they invest in.
Absolutely.
Okay. So high risk can get probably more volatile, but potentially more growth. Someone who's more conservative get more safe program.
More in the equity side.
Okay.
Okay, where if people are more low risk, they're more down in the bond and balance side.
Okay.
Okay, when you get into the high equity side, that means you don't care. You're just throwing it out there. You're dealing with large corporations, small cap corporations. It all depends on where you really want to go in this situation.
So that's
going to benefit the individual.
So that risk evaluation that you do is key to the whole process.
It's very key. If a person do not do an investment profile, it's danger.
Okay, all right. So you've sat down with the client, you've determined their level of risk. What sort of things sort of investments would you suggest people might want to look at to invest their money, particularly if, say, they're talking about a large sum, let's say, from the sale of their house? What sort of investments would you suggest people look at? I know obviously it's going to be different for individual person to person, but let's just say, like, what are all the possible options that you might use?
People can put money into an RRSP. People can put money into what we call a non-registered investment. People could put money in what we call a tax-free savings account.
Okay.
Or people can invest into real estate. Or they can put money into the stock market 100%.
Okay.
It all depends on where that person feels comfortable to put the investment based on the advice of the financial advisor or the insurance advisor or the wealth counselor.
So you, based on the risk assessment, you put together a plan for the client saying that I'd recommend you invest in these different things to fulfill your goals.
That's correct.
And then, of course, it's their decision if they take that program or it can be modified if they want to make some additional changes.
Well, what we have is we have a computer system that when we ask questions, is logged into the computer, and the computer will tell us exactly where that person should be. And then we ask them, do they feel comfortable with doing it that way? Because we can scale them back if need be, to make them feel comfortable that their money is working for the best interests of them.
Okay, so by putting this plan in place, you're able to pretty much eliminate the risk of people running out of money.
Well, you really can't eliminate the risk in that factor when you're putting it in the stock market and in those areas, because remember, the stock market can go up and the stock market can go down.
I know,
But we have different types of investments that we can put them in that will basically say that it's going to guarantee X number of dollars when it hits a certain time period. That time period could be 10 years or 15 years. The time period for 10 years, 75% we guarantee of your principal. If we go 15 years, we guarantee 100% of your principal.
and now what product is that has this
That would
guarantee?
be what we call a segregated fund, and that would
Okay.
fall under the insurance umbrella, where we would put that in a segregated fund that would be very, very beneficial to people that are afraid to lose their money, to make sure that things are working to their benefit.
So a segregated fund is similar to a mutual fund, isn't it?
Yes, it is. Very,
So-
very similar.
If someone's not familiar with a segregated fund, but with mutual funds, they're similar. I know there's some differences, but they're a similar product.
Yes. The big thing about segregated funds that we have right off the bat is creditor protected. So that means claims of creditors can't get that money as long as you have a named designated beneficiary.
Interesting.
Okay? And that protects a person knowing that if people are sue conscious today in today's world, they can tap into those assets. Or let's say you're driving your car along the way and bang, you hit somebody and kill somebody. Now they can attach to your home, your bank account, and all those other wonderful things out there.
Okay, so segregated funds have the additional benefit of being creditor protected.
That's correct.
So that would be one of the things that you would sit down with people and look at as one of the options to
Exactly.
invest in. So segregated funds, mutual funds,
Yes.
stocks, bonds,
That's right.
mutual funds, and come up with a portfolio that will work for them.
That's correct.
Okay, all right. Is there anything else that people should know about that's good starting information for them if they're looking to
Well,
put a plan in place to
the
invest
major
the
key
money?
for not running out of money is to put your money into an annuity. Now, people tell us that there's a fixed annuity, there's deferred annuity. If you put in any one of those plans will go to the end. The plan will outlive you. That's the beauty of having that plan. It's one of the only investments out there that will not have a juggernaut of going up and going down.
So okay, so let's talk about annuities now, because that might be an interesting
Mhm.
option for some people. So what exactly, let's start with what is an annuity?
It's a stream of income. That's what an annuity provides. It's a stream of income.
So I'm gonna get X number of dollars a month,
That's correct.
every month from now until a certain time period or until I die.
It all depends on if you take the life annuity, it's lifetime. If you take the term certain annuity, it goes 10 years, 15 years, 20 years. Some
Okay,
of them go 25 years.
so I can buy it for a certain time period or I
That's
can buy it for the rest of my life.
That's correct.
All right, so what exactly do I do if I want to get an annuity? If I say that sounds good, I want to get an annuity, what do I do?
They give me a call and we sit down with them. We do the proper planning that they have to have. And we ask some very thorough questions in that particular area and how do they feel about it. Because remember, an annuity does not work like a RRIF, a registered retirement income fund. Why? You can break up a RRIF at any time and say, hey, I want to take my money and run. But remember, when you take your money on that large chunk, taxman, CRA sitting there saying, I want my share too.
So wait a minute, so the way it works, if I understand this, you would buy an annuity and say someone gives you $500,000 to be invested in an annuity, and that will give them for a certain time period and a
Or a
certain
lifetime.
well, that's a time period, or a certain income.
That's correct.
So then they would get back an income based on that $500,000 that they gave
For
you.
the rest of their life.
Okay, All right, so this, how much they give you would depend on the size of the payment they want, I guess, each month.
That's correct. It's a
Okay.
percentage, because, you know, you have a percentage in RIFs too.
Exactly.
4%, 5% of the total amount that's there. Some people want 7%, but sometimes those plans can run out of money.
Okay,
Annuity basically just chucks along. And let's say if you have 500,000 and you took your 500,000 with a lifetime annuity, once you hit that 500 mark and they done paid out, they have to pay you for a lifetime. So now you're on the insurance company's dime.
so wait a minute, if you buy the lifetime annuity
Yep,
and you live a long time and you burn through all the money you've given them, they still gotta keep paying you.
that's right.
Because it's technically some sort of life insurance product.
That's right. It's lifetime annuity.
Whereas if you buy, say, a 10-year annuity, at the end of the 10 years, you're still alive, it's done.
That's right.
Okay, all right. So that is an interesting option for somebody if they want to, if a guaranteed income is a concern to them, that's an option they might want to look at.
That's right.
Okay,
That's right. And I'm going to say at this stage of the game, that's more than enough information that we're basically sharing at this particular time. And if they really want to, give Fred Perry a call at 902-989-1041. Or you can give me a call by just doing an email to me, fredcperry11@gmail.com.
all right,
Have a
if
wonderful day.
you missed his contact information, we'll put it down below in the notes, so you'll be able to get it there. Is there anything else, Fred, that we should be telling people about this topic?
I think this is the time for them to meet with the advisor and let the advisor basically explain things in detail with them.
Okay,
Because if you want to get really technical in detail, that's one-on-one.
fair enough, because everybody's situation is so different that
Exactly.
you really want to know what their situation is to be
Exactly,
able to give
Roy.
them advice that pertains to them as opposed to something that's so general that it really has limited value.
Exactly.
All right, if you have any questions, you can feel free to give Fred a shout. Thanks very much for watching the video. I'm Roy Thomas with Sutton Group. You can reach me at 902-497-3031 or visit my website, roythomas.ca. Thanks very much for watching and have a great day.